Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guy TV. Well, we got crazy markets again, and everything's based off of news headlines. No actual, change in fundamentals, but the news headlines are that trade deals are happening, and because of that, we're seeing a big run up in the market. And interesting enough, we've seen Bitcoin make a recent high, and we had strong news on Coinbase yesterday, just ahead of their earnings, which kind of confused why they didn't wait till their earnings report to make the announcement. But there's an acquisition that's going on with Coinbase, and they're looking to buy another marketplace, and it was perceived as good. Stock went up. The company announced earnings, and in general, the earnings were mixed. They didn't blow it out of the water. They didn't get hurt. The stock was down after the initial news, but just a minute ago, we were flat. Now we're down 69 cents on the day, which was, okay for our trade. We went out and did something different, and we did a 1x3x2 butterfly, and we did it on the May 9th expiration. And we're going to receive that net credit to the account. We got it done for 34 cents, and that was our goal. We had, let's see here, we had $5 worth of risk, $500. Let me set up the trade, and we got it done for a net credit of 34 cents. The fact that the market opened down, all the volatility has came out. If the market did come up, we're in a really good place at this point in time on this trade. So let's set up that trade to start with. We're looking at the 210, 215, 220. So we're still within the one standard deviation move, which is not bad. Saying that it is possible it could come up to here. 215, we did 3 of them, and then 220, we did 1. 2. No, we did 2. 1x3x2. Now, here's the biggest thing about setting up fancy butterflies, if you will, and I'll just send it to the what if calculator, but we'll come back and look at the screen. Is that these numbers have to add to the middle. So the green ones have to add to the red one. And if you do that, then the trade is covered, right? In other words, we're long 1 of the 210, we're long 2 of the 220s, and we're short 3 of the 215s. But 2 plus 1 adds up to 3. That means that we're covered on this trade. Now, we did an extra credit spread of the butterfly. So we sold 1 more credit spread, and we got a lot of juice for that, especially because it was around earnings. Coinbase announced on a Thursday, and once again, so we have 1 day for these option contracts to live. Market was down a little bit, which is good. This is the ideal situation. Honestly, I don't think you can get a better situation than what happened with Coinbase with this trade. Basically, the company announced earnings. Very volatile stock in general, usually trades at about a 65% implied volatility. All the volatility comes out of the option contracts, and the stock doesn't move. We have a butterfly on, and if the stock moved towards our butterfly strike right away, that would have been too quick. We need time decay to happen. We need implied volatility to come out. It's happening now. The only thing that we would like to have happen, and this is the total difference between doing a short call spread, which that's what I'm billing this as an alternative to, and doing a skip strike or ratio butterfly. Some people will refer to this as a Christmas tree butterfly. But in this scenario, well, Christmas tree means that there's you're a little bit more skewed. But with that said, if we do this trade, now we can let it ride. We can see if it comes back, because every hour that goes by, and if the stock starts drifting north towards our 215 strike, we could potentially make another $5 on the trade. We're right now, it's looking like we're going to make the 34 cents. If we were in a short trade and it started coming up towards, if we were just in a short call spread and it started coming up to the 215 strike, we'd be panicking, right? We'd be, oh my gosh, it's going to finish in the money. Oh, we better close it. As a matter of fact, if we were in the short call spread, we would close it right now. But we can get out of this trade for a net. Well, we flip the script. We can, it's actually more profitable. Because of the butterfly connection, we could actually close this for a 24-cent net credit to the account. Okay, because we would flip the script. So let me go to the what if calculator. Let me explain this way. I think this will be the better way. Okay, so like I said, the best case scenario that you can have after earnings, after our setup, is that the stock basically opens flat. Implied volatility comes out. You don't have the market go down. If the market goes down, fine. We would make 34 cents. We'd be out of the trade. We'd be done. But now we have a chance that the market could come back, drift on up into this range, and land somewhere where we're more than profitable. We got $5 worth of upside, and you got to focus over here where this would be. Now, this is based off of today's price. So now realize that this isn't exactly the trade that we put on. So the market comes back in this range. We could make that $5. And it's showing you actually fairly accurately. This isn't bad because usually models will break down when you get close, very close to the expiration. But this line right here is going to start drifting towards this. So to start with, if it goes to our beginning strike of our butterfly, we're going to be profitable. And if it continues on up, and if it as every hour goes by, this line has to morph the what it looks like at expiration, because it's going to be expiration. So every hour that goes by, this is going to drift higher and higher and higher and higher and higher until this point of this green line goes to here. So because of that, if you were to put this trade on right now, remember, we did it for a 34. What was the number that I had here? We did it for a 34-cent net credit, according to my screen grab. Yeah, 34-cent net credit to the account. And I remember we put it on, it was like right around 38. And by the time that we finished the show, we were right around 34 cents. So a few pennies less. But in this instance, we came all the way up to here. Now you would have to pay a 16-cent net debit. So at this point in time, if you wanted to, and you wanted to close this position, this would be sell to close. This would be buy to close. I got to click open though, and sell. And you could get a net credit of 14 cents. So you put it on for a net credit of 34 cents. You take it off for a net credit of, let's call it 20 cents. Let's just make it 20, and then we don't have to worry about it. Oops, just missed it. Of 20 cents. So if you did this trade right now, or even got out of it on the open when the market was up just a smidge, you probably did better. If it's outside of the strikes, right, you want time premium to help out with the butterfly, just in general. If it's outside of this, it's below the strike. If it gets in the strike, you don't want time premium because you are short 3 of these, and you're short 3 of those, and you want those 3 to go away. You know, you need those to be 0 to make the max profit, or as close to 0 as possible, because you would have to buy those back. So very interesting trade. Last trade is 204. We are down $2 on the day. It's going in the wrong direction, but it would be really nice if, but there's no reason to get out, right? Okay, there is a reason to get out in that you're going to lose this 20 cents if the market stays where it's at, right? So I guess there is a reason to actually sell it if you want to try to capture that 20 cents. We're trying to capture 34 cents. Let's capture the other 20. I think you would just in general lean towards that. But if you had 2 of them on, you'd sell one and you'd maybe let one ride. See if this market could come back. The earnings weren't horrible. They're making moves. It was perceived as good, the announcement yesterday of the merger between the 2 companies. And yeah, there you go. Any questions on it? I liked that trade. That was fun. Because we were struggling. We were looking at a skip strike butterfly, and we decided to go this trade. And, every stock is different. The fact that a stock trades at $200 versus $100, that's a big deal. The fact that it announces on a Thursday as opposed to a Tuesday, that's a big deal. There's just a lot that goes along with the thought process on each and every one of these trades, especially if you're trying to do them around earnings. If you're just buying Coinbase to buy Coinbase, yeah, that's a much easier strategy selection process. All right. So let's go back and look at what our Netflix trade too, because Netflix is moving. So I'm going to pull this up real quick. Like Netflix yesterday, we had Netflix at $1,150 and change. And our trade, we went out to had the May 9th expiration, 1,200. Okay. NFLX. Netflix it was up in the AM. Yeah, no big deal. It's gonna. Well, so we put the whole trade on for about 84 cents, the skip strike butterfly that we had on. And now we wanted the market to go towards the 1,200 level. And if we look at this trade, we're at 1,138. It's going to expire worthless. And that was fine. And here's what it was. We looked at the chart and we never even came close to getting nasty on it, right? And just overbought conditions. So the market, look at how many up days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days in a row of positive candles where it closed higher than it did the day before. Just solid, strong movement to the upside. Just a little bit overdone, right? If you look at where the market was and where the highs were. So we sold we sold skip strike butterfly around this nice round number, the 1,200 level. And right now that skip strike butterfly is going to go out worthless. So let's do a rinse and repeat. I think we keep it right where we're at. When we put the initial trade on, I'd have to scroll back to look at where that was. Okay, but I don't. Yeah, we're probably somewhere around in here. Oh, this is where we were. Actually, right at that high. I remember that. And then we had a down day, but it still finished up. All right. 1,200. So let's set this up. This will be the paper trade for the week. We do still have some earnings, so we'll look at some earnings next week too. I was really hoping that this was going to rally up towards our number, but it didn't. This would be the day that you'd want it to rally, just like how we want Coinbase to rally. So let's go in and look at our trade. We'll go out. Let's look at the 7-day and then we'll look at the 14-day. We don't have earnings as a catalyst, so we don't have as much to worry about. Netflix isn't really a discussion in the trade wars. Well, I guess I can take that back. The movie tariff, I guess, could have some implications, but nobody has any idea at this point what the implications are, and it's got to get. I don't know. There's just a lot more news that go. The market panicked to start with, and yeah, the market panicked and kind of drove the stock down a little bit, but it didn't react too hard to that news. Okay. Let's look at it. The only concern would be that news comes out that it's not that big of a deal and it turns out to be a catalyst to the upside. I guess that might be a concern, but it's not that big of a concern in my mind. 1,190. Let's do the same one. I think we're going to do the exact same one. Let's try it 7 days out. 1,190. Sell 2 of these, 1, 2, and then we're going to skip and go to the 1,220, and that's our skip. 24-cent net credit. All right, let's send that to the what if calculator. And let's go look at a different one. Let's go out to the 23rd. We're going to clean this up. Be not a little bit less than the 1 standard deviation move. 1,190. Let's buy. 200. Let's sell. Skip the 210 and do the 220, and let's buy. So we got a 92-cent net credit. That sounds a lot more interesting on $5 worth of risk. Got 2 weeks for the stock to get up to that level. If it goes down, so our goal is to make as much as that 90. What I'd really like is to have a Wednesday expiration, which is right in the middle. We're 7 days out, and our 7-day out trade, I'll send this to the what if calculator. And our 7-day out trade is just a little bit less than our 14-day out trade. I'm going to lean to the 14. Let's do the 14. 7 days is a fairly simple trade in my mind. And once again, it's all about when you put this on, see the green line? If it gets to the strike, we're down. But if we were in a short call spread and it got to the strike, we'd be down even more, right? Because we wouldn't have the offset of the long call spread that's in it. You would receive more of an initial net credit up front. Now, so here, if we do this one, we're getting it done for, I think it was 23 cents. The same scenario is here, but every day that goes by, this is going to start drifting up. So do you do it for 23 cents? And if you're doing it that way, you're kind of hoping that the stock comes towards our strike. If you do this way, you just kind of want the stock to go down and you make the 92 cents on a $1 trade. So if we let's look at this alternative here, and let's break this down immensely. We're on the May 23rd, 14 days away. If we did the credit spread, right? I guess I'll just do that. We got the what if calculator, so we'll just do it. Let's clear it out. So remember, the 220 is the one that we're buying. That means that we embedded the 210, the 1210 and the 1220 credit spread inside by skipping it. Okay, cleared out. Sell this, buy that. So that's 140. Okay. I'm going to completely break this down because I kind of like this. I'm right on the fence between going 14 days or 7 days. But we're at 140. To do a short call spread, send it to the what if calculator and bring it back. Okay. So this means you want the market to be below $1,210. You want the market to be below $1,210. You want it to trade south of this. You're bringing in a net credit of $1.40. Not a bad trade. I don't mind this just in general, considering that once again, Netflix stocks don't usually just go straight up 20 days in a row. Eventually it's got to give back a little bit. And in this instance, this net credit for 14 days, you're still getting 32 volatility. You're still getting some juice on it, on a very strong up move on a stock that is kind of a darling of the marketplace right now. Don't mind it. But what we're doing by doing the skip strike butterfly as an alternative to a short call spread, not as an alternative to the butterfly, is we're using a part of this credit to pay for the butterfly. Okay, so let's remove the strike, because remember, that's the one we're skipping. Yeah, I'll just do it that way. And then we're going to go to the 2010. We're going to hit this one twice. And then we'll go down to one more and hit the 1190 and hit the ask. And now we're 93 cents. Okay, so we said 140. This would be That means the butterfly is 47 cents. All right, I'll show you my fancy math. Would you rather do this trade, receive 95 cents, and have the benefit that if the market goes against you, right, to the upside, you have a buffer, you have the butterfly in? Or would you rather just do the credit spread outright, and if the market starts going against you, you just have to close it or you have to roll it? Here, if it goes against you later in the trade, you're okay. That's simple. That's straightforward. I always like these as an alternative, especially got something that's got some volatility and some predictability. I know it's an oxymoron, but bottom line is that's where we're at in Netflix. We got some volatility, got a strong move to the upside. Chart does not look bad to try to say that the move to the upside is overdone. Not saying that it won't go higher long term, but in the short term, kind of overbought. So now if I click on this, it's going to say the butterfly is right around 47 cents. Okay. So we're going to remove the 1220. Careful surgery here. And we're going to buy the 1210. 43 cents right now. Well, 45 is where it came up at. Markets are moving. But yeah, you're selling the credit spread, taking some of that credit and buying a butterfly. And that's what by skipping the strike, that's what it does. And if you'd like to learn more of that, let's move out here a little bit. Let's move out to the big screen if we can. And we're going to pull this back. And I'm going to pull up something. And I'll show you this because I know this is an advanced strategy. And I've liked these even since I wrote the options playbook. So I'm going to show you where it's at. All right, let's go and pull it up. Let's go to options playbook view. All right. So all you have to do is type in skip in the search button, and this is what comes up. And this is showing you the layout, talking a little bit about how you can think of this strategy as embedding a short call spread inside a long butterfly. So I go into great detail in the book on those thoughts. And here's just a generic layout of a skip strike butterfly. All right. Any comments, any questions? And if not, we went a little bit long on the show, had a couple issues getting going. But with that said, that's it for this. I'll leave it right here. That's it for this episode of Options Guy TV. My name is Brian Overby. Follow me on Twitter. My handle is @BrianOverby. We stream our Options Guy TV live via that Twitter handle, also through the Tradier Twitter handle. And the ideal spot to watch Options Guy TV is inside the Tradier hub, hub.tradier.com. Get access in a nice format to all the speakers that Tradier Tradier puts out there to try to educate the client as far as option trading is concerned, futures trading is concerned, and stock trading all the way across the board. So thanks for stopping in, and we'll see you this Monday for the next edition of Options Guy TV. And just one last thing, go coin. I would love to see a 5-point move to the upside. That would be awesome. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.